I could have a balance of 0 and a home that's worth $2 million. Does that give me access to that money? Like I have $2 million now? No, it's still locked up in the house. Mortgages are actually something that, as funny as it may sound, is a past passion of mine, I guess you could say. They somewhat still are, just understanding them, knowing how they work, and being able to provide that knowledge and service for my clients. In 2006, I got a mortgage license. And this was right after, in the state of Utah anyway, that to do mortgages didn't even have to have a mortgage license to do it. You were just under a bank or another principal's license, and you could just do mortgages just by wanting to do mortgages. And this is back when there were several hundred different loan programs that people could do, and it was a booming market, a booming industry from 2006 till about 2009, before the real estate market crashed. Mortgages were a pretty healthy chunk of the business that I did. And so understanding mortgages, how they worked, why they worked, what it did for a family to do it the right way, the wrong way, is where I really started to see in the financial industry how many people were doing mortgages just to make money. And definitely that's a part of it. There's nothing wrong with making money, but then there's people that do businesses to make money, and then there's people that do business to make money and help people, and realize that in the helping people, they make more money than they would by just focusing on finding something that pays them a lot of money, right? And so that's where those lessons started, but it was in the mortgage industry when I got licensed back in 2006, and understanding that from a financial perspective is hopefully one of the biggest debts that people ever have in their lifetime. And so as silly as it sounds, the only way to get into debt in a mortgage is we have to have previously been in debt in other things to prove that we know how to be in debt and that we can make those payments. And so there's a lot of factors that go into purchasing a home, whether that's a first-time purchase or it's a second or third or fourth purchase. There's all types of loans. There's construction loans. There's conventional loans. There's FHA loans. There's VA loans. There's PMI. There's LTV. There's DTI. There's all these terms and phrases and acronyms and letters and initials and all these different things that we have to try to keep up with. And so that's what our lesson today is going to be on, is just understanding the terminology of mortgages, and whether you use that for your own knowledge, whether you use that to help someone else, or whether you deal with mortgage people or real estate people and you just want to understand the language better, or you just want to look cool when you talk to them and you can speak their language, I guess you could say. And so let's talk a little bit about some mortgage terminology today, and then specifically dive into really there's two kind of different types of mortgages you can get when you're looking to purchase a home. So first thing we're going to do, because I'll just reference these a couple times as we go throughout these different mortgage lessons, is one of the things that you run across when you're talking about mortgages are the initials LTV, loan to value. And the two, if we were to translate it, is basically saying compared to. Okay, so LTV is loan compared to the value. And some of you that have purchased a home before are going to be like, well, no kidding, I already knew that. But here's the thing, not everybody knows it. So that's why we're talking about it. So loan compared to the value. So, for example, if I'm going to buy a this is a squeaky marker today, a $300,000 home, and my loan is going to be $150,000, my loan to value is 50%. Loan to value in this example is 50%, and the math is all done the same way on everything else. So there are several different types of loans that have different loan to value qualifications, or what you have to bring to the table, or some people will call a down payment, what you're putting down on the house to bring down what the loan is you have to get, so that they can calculate what the new loan to value is. So there's an FHA loan, there's a conventional, there's home equity lines of credit, or lines of credit, there's VA loans, there's a whole bunch of different types of loans there. There's a home equity conversion mortgage, and so each of these have different loan-to-value requirements. So, let's see, different color. Wow, that one works good. Okay, so with an FHA loan, for example, you have to have a 3.5% down payment. So, what that means is that the loan-to-value, in order to qualify for an FHA loan, has to be 96.5%. With conventional loans, there are some conventional loans currently that you can do and have a 0% down payment, making it a 100% LTV loan. But more commonly, you're going to see about a 5%, and I don't know if I'm going off the camera here or not. I don't think I am. I think we can see that. Is a 5% down payment. Okay, home equity lines of credit usually won't go higher than an 80% loan to value. Home equity lines of credit. Okay, we're not talking about what a home equity line of credit is today necessarily, but just that there has to be 20% equity left in the home. VA loans don't require a down payment, and home equity conversion mortgages, you have to have at least 50% equity in the home in order to qualify for those. Which brings me to something that we should probably talk about. When I was younger in the financial industry, I started in 2005, and I was 21 years old. And so a lot of these terms I didn't quite understand, didn't quite get, and I remember it actually took me a little while to understand what equity was. And most people know that, but then what's kind of tricky about equity is people say that your home is an investment, and the reason it's an investment is because that investment grows, 3 to 4 to 5% per year, where that's just not true. The value of your home could go up 3 to 4 to 5% per year, but there's no investment there because it's not money that you can just pull out at any point to do other things with unless you want to pay it back. The only way to get that equity out is you have to loan it to yourself. And so yes, it's building value, but if we can't access the value, how valuable is the value? Does that make sense? So if we were to draw a home here, here's my house. I buy it for $300,000. I do my loan to where I owe $150,000. It's worth $300,000 today, so therefore my equity. So this is my balance, and my equity would also be $150,000 in that scenario. Obviously, the only way to access that equity would be sell the house so that I can actually get to it. And so, I could have a balance of 0 and a home that's worth $2 million, and does that give me access to that money? Like I have $2 million now? No, it's still locked up in the house. It's in the floorboards, the walls. It's just the value that someone would be willing to pay for that wood, concrete, rock, shingle, all piled together, right? And so a couple of things that affect our equity. One is going to be as we pay down the balance of the home, that could be a way to build more equity if the value stays the same, or the other way to build equity is the value goes up. I was talking to a real estate agent the other day that said the only true investment is in real estate because it always goes up. Well, if you owned a home in 2008, 9, or 10, is that true? So no, it doesn't always go up. Historically, does it have a very good track record? Absolutely. I'm not going to argue with that, right? But it's just, kind of looking at liquidity and all those different things. That's not what we're talking about today. But the ways that equity can be affected is the value could go up, giving us more equity, even if our balance stayed the same. We could make no payments. Well, the bank wouldn't let us get away with that. But if we made no payments and the balance didn't change at all, we were paying interest only, let's say, an interest-only loan, and the value of the home went up, well, we would be building equity in the home. If the value of the home didn't change at all, and we were making extra payments to the house, well, then the balance would go down, right? So that's what equity is the difference in what we owe and the value of the home. That's the equity that we have. So there are just some basics when it comes to equity, down payments, and LTV, which is loan to value. Okay, LTV, loan to value. Another one that you run into when you're dealing with mortgages is DTI. And what that one stands for is debt compared to our income. Debt to income ratio. So you have your loan to value ratio, your LTV, and your debt to income ratio. Okay, so there's actually two different debt to income ratios that mortgage companies look at, whether you're looking to purchase or refinance. You have the front end debt to income ratio and the back end debt to income ratio. Okay, mortgage people refer to this as DTI, but they don't ever say the FEDTI or the VEDTI. I'm just abbreviating that for my own purposes. But front end and back end. And so front end debt to income ratio is your house payment. So just the house payment by itself. So we could put HP. So the house payment compared to your total, if you're an employee and are W-2'd, your total gross income. Okay, before taxes. Okay, your house payment compared to your gross income. And that's going to be your house payment that is going to be the principal, the part that goes to principal of your payment, the part that goes to interest, the part that goes to your escrow account, which is going to be your taxes and insurance. Something that mortgage people will refer to is PITI. Is that your PITI payment? And that's principal, interest, taxes, and insurance. PITI. Okay, but then it also would include, and we may get to that today, we may not, is going to be whether you have to pay PMI, which is private mortgage insurance. That might be a whole lesson in and of itself, just understanding what that even is and what it's for, etc. But your principal, interest, taxes, and insurance, and I guess this could be considered an insurance as well, that's the front end debt to income ratio. So in the mortgage world right now, there are, in the different types of loans, for FHA loans, which usually have the highest debt to income ratios, they allow the front end to be up to 31%. So what does that mean? That means that your house payment could be basically 30% of what your gross income is. And so in my opinion, and this is something that I've talked about before, is an interesting thing about America is, yes, we want to encourage home ownership, but another thing that's kind of skewed about this is we're allowing people to, if they make $3,000 a month gross, which is before taxes. I mean, so you take $3,000 gross, you subtract out taxes, you subtract out their 401k contribution, you subtract out that they need to eat and they need to, you know, stay alive and all that. Once they actually receive their money from their job, what would be really, really interesting is compared to what they actually receive, what is their debt-to-income ratio? Not what they're making, because everybody, you know, knows that if you have a $15 an hour job, you don't get to keep $15 an hour. You're keeping about 12 or 11 or something like that, right? And so when you really get down to it, you're looking at about 40% of people's total bring-home income is just going to a house payment. And then we wonder why America's in such a crappy financial situation, right? Is what's funny, what would be such an interesting social experiment to do, raise or lower this and watch people go make more money. Just to watch what could potentially happen to people's ambition, the economy, etc. This is me, you know, crystal balling something. Lower what requires to get into a home. Initially, less people would be able to buy a home, but then they would go and acquire more skills, abilities, etc., so that they would just make more money, right? Anyway, so 31%. Then you have the back end. The back end debt-to-income ratio. That what that is comparing is your total debt payments. So that's going to be car payments, credit cards, student loans. I mean, anything that when you pull credit, you can see that there's a debt payment. That's your total debt payments, your monthly debt payments compared to your gross income. Again, if you're W-2. Well, what if you're not W-2? The question is, what if you're not? Well, unfortunately, and fortunately for you, you get to do the little dance and to play the little game of, do I pay less in taxes or do I want my debt-to-income ratio to look higher? Because if you're a business owner, you make $200,000 according to you. If someone, you know, is asking about your business and you say, I made $200,000 last year, that's a true statement. But according to your debt-to-income ratio, it might be $80,000 according to that. And so it's just that balance of, do I take all these deductions so that I only owe taxes on this, or do I not take the deductions so that my number is this? Because when it comes to a business owner, they go off of this number after deductions, where if you're an employee, they don't take into effect deductions at all. Which I could go off on how messed up that is for a long time. So back-end debt-to-income ratios, FHA loan, which again usually has the higher allowances, this one's going to be about 43%. 31 and 43. So if they take the new house payment plus cars, plus credit cards, etc., add all those numbers up, compare it to the gross income, and that is going to be the back-end debt-to-income ratio. So this is one of the, well, two, I guess. 1, 2. Two of the qualifications that mortgage companies look at when someone's going in to qualify for a loan, whether it's first time or a subsequent purchase after that, or even a refinance, these are some of the things that they look at. There's obviously other factors that we'll talk about on future lessons. Those terms, those concepts, so number one, number two, loan to value and debt to income ratio, that is our lesson for today here at the Impact School of Money. Thank you for joining us, and we look forward to seeing you on future episodes. Class dismissed.